Latest inflation numbers from the United States have significantly increased the chance of another historic rate hike by the U.S. Federal Reserve. Of course, the Fed's going to make that decision next Wednesday, and a 75 basis point increase is expected. For more on all that, the inflation data we saw today and the market reaction, Ben Gossack, a portfolio manager with TD Asset Management. Ben, great to have you with us. This is one of those data points that's so carefully watched and heading into this, like, will it be lighter than expected or hotter? We got hotter. Walk me through the reaction.
Yeah, I mean, it was clearly the main event that the market's been anticipating for over a week. I wore my special lucky horseshoe tie. Obviously, that didn't help for inflation, but at least you and I get to enjoy talking about it. So I'd say the big headline was leading up to this. Month over month inflation had been coming in at around 1%, so we had a steady increase. In July, there was a marked deceleration. I think that brought hope and optimism that the interest rate hikes that have been put in, the financial constraints have been doing their work on slowing the economy, slowing the pace of inflation, and that we were starting a new trend. Economists were watching gasoline prices, and gasoline prices had come down, and they thought that that would also bring down the inflation. They were right on that part. But what we saw today for August was not the beginning of a new trend, but that prices had held steady. For the core, for month over month, it was up 10 basis points. Sorry, for the headline, so that's gasoline and food, is up 10 basis points. But I think what surprised the market was the core. So when we take out gasoline, energy, it was up 60 basis points, so 0.6 of 1%. And then on the year over year, it was 8.3 for the headline and about 6.3 for the core. It just means that prices are holding steady. I think to your point about next week for the Fed and their meeting is that 75 basis points is priced in. I think it also opens up the window for a 100 basis point increase. That discussion is in there, and I think that's why the markets are down today.
Let's talk about, I guess, the utility of going a full 100 basis points. I mean, we've already done it here in this country, I guess 2 decisions ago for the Bank of Canada. What does that do? I mean, really, in the end, they're just trying to change, I guess, consumer psychology. If you can't correct supply chain problems, you can't correct conflict in Europe, I guess the only thing you can do is just try to slam the consumer into a place where they're going to stop throwing the money around.
Yeah, there's not much the Fed can do. I think many central banks can do. It's very stark when you look at Europe. You definitely know that the rising prices are not really the fault of the central bank, and yet the central bank then has to raise rates and constrain, and obviously you can see it puts pressure on many financial institutions and individuals. I think what, when we zoom out, I think what the market's more worried about is if inflation continues at this pace, the Fed and other central banks have to keep hiking. And now when we look at where we think their Fed funds rate will peak, you're looking at about north of 4% at the end of Q1 in 2023. The effective funds rate today for the Fed is about 2.3. So we're talking about a doubling of the Fed funds rate. And so again, that puts a lot of pressure on corporations, that puts a lot of pressure on individuals. What's interesting to me though, is that while we're having a lot of inflation today, and it continues to last a lot longer than anyone expects, when we look at long-term inflation expectations, I noticed they actually went down today. So we look at inflation expectations over a 10-year period. We can cut that up, and we can look at the first five years, and we can look at the back half, and all those inflation expectations have been coming down.
What is going on there longer term then? What has people thinking that once you get past this volatility and some pretty tough prints from time to time that we will be, could I even say, a disinflationary environment in the future? Yeah,
so I think near term wise, I think it's supply chain, it's geopolitical tensions. It's still a robust, surprising labor market. Canada, we've seen job losses in the last 3 months. The U.S. has held up a lot stronger than, again, more of us have expected. Those prices have sort of stayed persistent. But I think the market does believe at some point all of that will come down because we'll have central banks will have hiked one time too many, causing something to break. I think long-term wise, when we look at long-term inflation expectations, and we start to think about the drivers before COVID. It's like there was a life before
there was
the COVID-19 pandemic.
This, yeah.
And so when I look at the U.S. 10-year rate, we're about 3.5%. And I look back across the historical chart, we were at those levels in 2018. And back in 2018, we were in a slower growth environment. You talked about disinflation. We thought, inflation had been cured. We never had to worry about it. And even back then, we think today 3% is a pretty good yield. That wasn't satisfactory for many investors, albeit like 4 years ago. And many of them didn't want to have fixed income in their portfolios. And we're going into corporate bonds and high yield and other exotics to find their income. And so I think all those pressures in terms of the amount of debt that the economy was carrying, the demographics of our population, and the disinflationary forces of technology haven't disappeared. If anything, they've been below the surface because we've been distracted by many other different headlines.
What does that mean then for income investors going forward? Obviously, this seems to be, we're going to have a pretty bumpy ride for the next little while, but how should an income investor approach this market longer term?
So I think, again, we got to separate the short term and the long term. Long term, I think those forces that we talked about, again, in that 2018, 2019 period that never went away, means that we're set up for slower nominal growth. And if we're set up for slower nominal growth, I think that leads to sort of a lower interest rate environment. Again, putting pressure back on workers, putting pressure on people that have retired but we're living longer. So having to still set aside savings in order to make sure that they don't outlive all their savings. And so again, that will put pressure on people to find income. But having said that, there are still many places to find income, and that's why we focus on the areas that are growing. So while the overall economy might be slowing, and maybe we go back to sort of 3% nominal growth, you want to look at the areas, the secular trends. It might be in healthcare, it might be in payments, it might be in electrification. Clearly, decarbonization are big trends, and those are areas that will grow faster than GDP. And those are the areas as income investors, our income growers, that's what we'll be putting in our investments.
It sounds like patience is going to be key. I feel like, and maybe it's because of what we've lived through since the pandemic hit full force in the spring of 2020, I find I'm a less patient person. Sort of want things resolved really quickly. I want to put it behind us. I want to move along this, and maybe time to take a breath, look longer term, and just be a little patient.
Yeah, and especially when it comes to income and income growth, it is very patient. So I remember I was just getting my hair cut recently, and the person cutting my hair was talking about that they were buying dividend-paying stocks. And I have a few shares, and getting a few pennies in dividends, and getting annoyed, getting frustrated. But again, over a 5-year period, 10-year period, 20-year period, if those companies are compounding, growing their dividends year after year at 10+%, it's not very long where all of a sudden the income coming to you on a quarterly or monthly basis is sizable and an income level that you could actually live off of.